Let's talk about speculation versus investing.
Sure.
I think you have come to know the difference, Quentin.
Oh, I, I do. I mean, I'm not sure. I'm not sure there's always a fine. I mean, I think there's a very fine. I don't want to say a fine line. There's a great line, but I mean, what I always say is nothing in the world is digital. It's analog. So it's not like speculative or um, you know, investing. A lot of times you'll. I mean, a lot of times I'll buy into a company that's a solid company, but with the idea or the knowledge or what I think is the knowledge that they're going to break into an area that will give them an advantage. In other words, to me, that's a speculation. It's not a wild speculation. I don't think the company's going to go up 10x, but I think the value of that company will increase more than it typically does. And so to me, that's. I mean, I'm not a wild speculator, but to me, it's a speculation. If the company doesn't do well there, it's not going to go out of business because it's a fairly large, stable company. But you know what I mean. But I still consider that a speculation. I mean, so. But yes, I understand the difference.
Yeah, I mean, I'm well, we're both older people. I'm 68 years old now. So a very important part of investing for me
Yeah.
is dividends. If I
Okay.
don't have dividends, I won't eat. So everything I do, I don't mean to invest in for the highest dividends, but I have to consider the ratio of stocks which are not yet paying dividends to the
Mm,
stocks which are paying dividends, so
right.
that within the collection, there's enough dividend income so I can go shopping, if you like.
Right.
And also from a speculation point of view, I really want to avoid things which are speculative, where the gains are uncertain. It's much more about will the company still be there tomorrow and next year and the year after. So
Right.
one of the things I always look at when I'm buying companies are things like debt levels,
Oh,
debt
sure.
to equity, at cash flow levels. Do they have more cash flow, or do they have sufficient cash flow coming in? Are they servicing their debt?
Right.
Um, and do they have a business which I reasonably think will still exist next year, the year after, or 10 years from now?
Yeah.
As opposed to, if a company's got an exciting new product, can I be sure that product will still be there 10 years from now? And if
Right.
not, I'm starting to border on speculation.
Well, also if they have a reasonable dividend and you believe that people buy it for the dividend, how reliable is the dividend? Because the other thing that happens is when a company offers a dividend and it's attractive and people buy it because they want that kind of income, and then something happens and they don't supply that dividend reliably anymore. Well, those people are going to sell it. So now not only have you lost the dividend that they're not supplying, but maybe because they've started to sell it and other people are interested in dividends and not interested in that company anymore, the value of the stock will go down, and now you've lost you've lost value in the stock. Never mind your dividend, and now you're sort of you're trapped, I guess. Well, I guess you can sell it and just take the loss, but you know what I'm saying. So you got to be
Yeah, I mean,
careful that the dividend is solid.
yeah, I mean that's the thing. Buying a company because it's got a dividend on its own is simply not enough. Another metric I always look at is what's called dividend cover. Now, that's something to look at if it's relevant. If it's not paying a dividend, or if the dividend is very low and it's not really relevant to me, it's maybe not such an important thing. But dividend cover tells you how much earnings they have covering that dividend. Now, the majority of companies do not pay out all of their earnings.
Right.
So, but what in an ideal world, you want to find a company which is paying a sufficiently high dividend to keep you satisfied,
Right.
and where that dividend is growing, and where there's lots of room for that dividend to grow because
Right.
the earnings are considerably higher than the dividend. And in the same corollary, I also stress look at the cash flow too.
Right.
the way I do that, I use a website called simplywall.st,
Mm,
and they for every company they show you how much the company's earning,
mm,
and on the same chart, in a bar chart, how much its cash flow is. And
mm.
if the cash flow is negative but the earnings are positive, well, the question I would have is, even though they seem to be making a lot of money, how are
Right.
they going to pay the dividend if the
Right.
cash is leaking out the door?
Right. So is that dividend? I forget the term you just used. Is that like a payout ratio? Is that a payout ratio?
Yeah, dividend payout ratio.
Yeah.
They could be paying 20% of what they earn, 50%
Right.
of what they earn, 75% of what they earn, or 100% of what they earn. Now,
Yeah.
most real estate investment trusts pay out 100% of what they earn because they
Uh,
have to by law to get the tax break.
right. I thought it was 90%, but whatever. Yes. Right. And
Yeah,
you
it could
can't.
be. It could be. It depends
Right.
on the
No. No. No.
country.
I don't know what the law is, but yeah. Yeah. No. I mean, I've always been told or taught or however you want. I've read whatever however you want to say it that I mean, you can't look at just an instantaneous payout ratio, but you want to make sure the payout ratios are less than like 60% because that gives them some uh, ability to maintain the dividend if things go down. I mean, you like to have the payout ratio as low as you can, in my opinion, as well, and have a high dividend, but that's not too normal. But because like I said, I don't want to see the dividend change because it'll cause people to leave. I mean, if it changes significantly, it'll cause people to leave the stock, and now that'll drive the price of the stock down. So, yeah, you want, and the company knows that too, right? So they don't want the dividend to change. They'd like it to go up to the right, up to the right every year. So, yeah, so I mean, everybody's kind of but when if they get trapped, they also have to. The biggest thing they have to do is stay in business. So so they need to cover that dividend all the time, and they need to cover it comfortably. I would hope so that they can continue to grow their business. So anyway, so yeah, payout ratio is kind of very important. But
Have you got
I was just going to say there are times when the payout ratio can get pretty whacked, out of whack. And that's why I said you can't necessarily look at it. Hopefully it's not a lot of the time, but you can't look at it in one instant and just say that's good or bad. In other words, I think you have to sort of look at a history of the dividend payout and also the payout ratio and also their all their metrics against their competitors, because sometimes just take a PE. Sometimes a company can have a very low PE or high PE, and then that might be totally okay within their industry. That's just the way their industry works. And so you know what I mean. It's I mean low PEs are good, but I mean you sort of have to compare them to their rivals or their competitors and
yeah,
people that want to get into their market as well. So yeah.
so companies with a low price earnings ratio are generally what people call value stocks.
Yeah.
But of course, for the most part, their price earnings ratio is low for a reason. Perhaps they're
Right.
doing business in a country which is politically unstable. Perhaps they have a very poor track record of up and down. Perhaps they're in a very cyclical industry, such as
Right.
shipping, for example, or perhaps their product is going out of fashion. They're
Right.
making black and white televisions, and there's some doubts as to whether we'll be buying them next year.
Right.
But on other occasions, you could get a company which has got a low price earnings ratio for reasons which are not particularly related to the fortunes of the company or the type of business it does or where it's doing business. It can happen that a share price has fallen for unrelated reasons. For
Right.
example, a member of the founding family has died
Mhm.
and the family are selling off the shares of a large shareholder because they have no choice. They have to pay the death duties,
Right. Right.
for
Right.
example. And of course, we get times when certain sectors of the market go out of favor
Right.
for, I'm not going to say irrational reasons. They are rational, but there may be reasons which are where the public at large are overreacting.
Right.
Good examples of that would be the COVID pandemic, when the price of cruise cruise companies, hotels, entertainment companies uh, went down to such low levels, it looked like they're all going to go out of business.
Right, right. No, I agree. There were plenty. I bet, but right, right. That I didn't. I mean, that's usually when things like that happen. That's what I look for. I look for deals, and because I'm kind of a value investor. But yeah, you have to be careful that the company itself is not actually going out of business. And I didn't and I didn't know enough about some of these companies to know, and because some of those industries are pretty. There's a lot of competition, and I just wasn't sure if any one of those, let's say, cruise lines or hotel chains were. I just didn't know enough about the industry to say, oh yeah, I got to go in there and buy whatever Hyatt or what have you. I don't remember the names that were really beaten up, but you know what I mean? Because I do think and I didn't have the time or inclination to go figure it out at that point. So, but yeah, I agree that picking up bargains is a great thing. But you've got to know. You got to do the research to understand the relative strength of the different companies. And yes, that's why you look at balance sheets and you look at the leadership of the companies and stuff like that to see what their experiences are. And
one of the stocks I bought during at the start of the COVID pandemic, when everything was collapsing on that crash day, was an advertising company. And the reason the advertising company's share price crashed was because some of that advertising was inside airports.
Oh, interesting. Sure.
So all the airports were going to close. Therefore, nobody was going to pay. Nobody was ever going to pay for advertising in an airport ever again.
Right. Right.
Apparently.
Right. Interesting. Yeah. No. But a lot of these things have they have a logical. They're logical, right? I mean, it does make sense but that also doesn't make sense. I mean, when you think about airports, it's not like the airport's not going to exist anymore. It's going to have to exist, and we'll have to find it. But yes, I can see how people would. And of course, once there's a rush for the door, everybody sees it and rushes for the door, So sometimes it's a smart thing to do, honestly. But anyways, because I've made a couple mistakes where I didn't rush for the door, and I was like, oh, it'll be fine. It'll be totally fine. And then the door closed, and I was like, "Uh-oh, now I'm stuck." So
yeah, it is very hard to distinguish between the real bad news and the bad news, which is not going to be permanent bad news.
Right.
And it's happened to all of us. We've read some story in the newspaper, thought, "Oh my God, this is bad for the company," sold the stock, only to watch it rise to all-time high after all-time high after all-time high. It's happened to me as much as it's happened to everybody. But on the other hand, there's stories where you see it go. I mean, I remember an occasion, and there was a real story. It was a Swedish company, and I think it was called Investor AB, which is a private equity investing company, but it's a very big Swedish company. And one of the founders had died, and the family were selling off the shares, although this wasn't public knowledge, but I could put two and two together by seeing that the guy had died. And the share price was trading at a significant discount to the underlying net asset value.
Right.
So this was an investing company which was valued based on a premium or a discount to NAV, but there was no reason for it to have gone to such a large discount unless someone was selling the shares. And obviously someone in the founding family was selling off shares to pay a death duty somewhere.
Right. Yeah, I know this. I mean, yeah, my latest debacle was a few years ago when I owned it was actually just an ETF, but I owned a Russian ETF. And this was like before the war started. And then the war started. And then the United States government cracked down and whatever, it did everything it did. And I think they ordered the ETF to close. So, and I thought, well, they didn't order it to close. People just rushed for the door. Right. And so I was like, what's the difference? I own, what's the name of the company? I forget the name. One of their biggest holdings was an oil company. That's one of the things I liked. And I forget the name of the Russian oil company, but, and they had other things in there that seemed like good companies, and I was like, what's the difference? I'll just hold it because I own a piece of this company. What's it called?
Lukoil or Rosneft?
Yeah, Lukoil. I forget. But anyways, it was a couple of years, three or 4 years ago at this point, and I was like, what's the difference? I mean, I had that same thought. Oh, I own a piece of the company; it'll be fine. Well, no, it wasn't fine. The fund was forced to close, and I lost everything.
Here's one. When Russia invaded Ukraine, there was a company traded on the London Stock Exchange called J.P. Morgan Russian Securities PLC.
Oh, interesting.
So J.P. Morgan Russian Securities PLC held a portfolio of mostly, but not exclusively, Russian shares.
Okay.
And the share price before Russia invaded Ukraine was something like £7 with but it was trading at a big discount to the NAV. The NAV was about £9 at the time. And obviously as soon as Russia invaded Ukraine and all the sanctions started coming in place, this share price crashed. And any company, even McDonald's, doesn't matter, any company on the planet which had some Russian assets, so McDonald's had a McDonald's in Moscow or somewhere, any company on the planet, their share price went down because they had Russian assets. So all companies around the world were rushing to get rid of their Russian assets.
Oh, sure.
So what JP Morgan Russian Securities decided to do was to write off or write down their Russian assets, not to a penny, they wrote them down to zero.
Oh, interesting.
So they still own these Russian assets, but they put a value of zero on them. And the consequence was the net asset value of this company was taken down from about £9 to about 35 pence.
Wow.
And the share price dropped from about £6 to about 45 pence. But this was 45 pence, which owned 35 pence of non-Russian assets.
Right.
Plus Russian assets, which were the same sort of companies, as we all know, like Lukoil and the big oil companies, which the day before or the month before had been worth £7 or £8.
Yeah.
And we're now on the balance sheet at zero. So it seemed like a great idea to take out. I was now paying a premium to what they said the assets were worth, but obviously knowing that there were some assets valued at zero seemed like a good idea. Now the share price then, as things wove on, a lot of companies realized that they'd been foolhardy to sell this company, and so pension funds and things were buying it, and the share price went up, went well above £1. And I think I sold it maybe double what I paid. Let's call it 90 pence, for example. So I did exit. Then the company decided to change its name. I have no idea what it's called now. It's called something. It might be called something like Greater JP Morgan Greater Europe, or that's not the name. It changed the name to something completely different. And whether they've disposed of those Russian securities or still keep them, I don't know. So don't go. I don't want anyone rushing out to think there's a bargain still to be had. But all I can tell you is the share price is much, much higher now, or was when I exited, than on the crisis day. But when something happens, there's always going to be a bargain if you look and see what it is.
Yeah, no. In fact, those shares that fund that I owned, they still. I mean, somebody else owns them, I guess, or maybe I don't know what they did with them, but they supposedly sold them, and they supposedly sent us back. They were supposed to sell them within 2 years, and then they were going to give us the proceeds back in some payment. And all I know is that all my money was basically, eventually it took 3 years or something like that. All my money was basically just gone. They probably all just got eaten up in management costs or something like that. But, but those shares still exist. You know what I mean? They could easily have sold. I'm sure they sold them to somebody else. They trade in other places that they're allowed to trade. You know what I mean? Anyway. So yeah, to me, I was very disappointed in how it all worked out. I mean, I expected at least something to come back, because I'm sure they sold it to somebody. I mean, I'm sure they took some kind of a haircut because they knew these other people knew that they sort of had to. But I didn't expect the haircut to be 100%. So, anyways. I was